Deutsche Bank just did something very strange. And I do not mean that in a negative way. I mean it in a way that should make you stop and pay attention. Because Deutsche Bank has more exposure to private credit than any other bank in Europe. Direct exposure. Indirect exposure through the funds they lend to. All of it. They have the most skin in this game of anyone on that continent. And when a bank with that much on the line breaks from the script and tells the public that the risk of systemic fallout is considerably higher than markets appreciate right now, you do not ignore that. You lean in. Because here is the thing. Every other major European bank CEO that got in front of a microphone last week said the same version of the same thing. Nothing to see here, no exposure, not material, non-existent. They sat at the Morgan Stanley conference in London and one by one delivered carefully packaged denials. Barclays, HSBC, UniCredit, Societe Generale, all of them, asked directly. Given the chance to be straight with the market. And what came back was a wall of carefully worded nothing. And then there was Deutsche Bank's Ozan Tarman, vice chair of global macro, the guy who arguably has a clearer view of what is actually sitting on European bank books than almost anyone in the world. He did not say move along. He said if it were not for the war in the Middle East, private credit would be the top story in global finance right now. Full stop. That is a strange thing to do when your bank has the largest exposure to the sector you are describing as a systemic risk. It is also a brave thing, and, most importantly, it is a true thing. Let me explain why. First, the exact quote, because it needs to be on the record. Tarman spoke to Bloomberg's Odd Lots podcast last Thursday. He said, "Headlines are not going away. If anything, they are definitely hiding behind Iran at the moment. It would be almost all we would be talking about, especially in the US. Let that land for a second. The man is telling you that the only reason you are not seeing wall-to-wall coverage of a brewing credit crisis right now is because there happens to be a war dominating the headlines. Iran is the distraction, and it is working." Tarman also said this, and this is the part that matters most mechanically. He said, if people cannot take their own money away from private credit and have to sell something liquid instead, then watch out for public credit, and watch out for public equities. I am watching that space very carefully. What if it spreads? What if some of the big US banks start lending less? What if insurance companies get hit harder and harder? Watch this space. It is a bit too superficial to say it is not systemic. I am more worried than that. More worried than that. From the banker with the most private credit exposure in Europe. Let that sink in. Now, let's talk about that Morgan Stanley conference because the contrast between what was said there and what the balance sheets show is almost too much to believe. Get a load of these quotes. Non-existent, marginal, not material, almost zero. That is how European bank chiefs describe their exposure to private credit when reporters press them. Barclays, HSBC, UniCredit, Deutsche Bank, Societe Generale, all of them, asked directly and given the chance to be straight. And what came back was a parade of carefully packaged denials. Where have we heard all of that before? Because it sounds very familiar. It sounds like every single credit crisis denial in modern financial history. It sounds like officials who know something is building and have made a collective decision that the right move is to say absolutely nothing useful in public. But then something very interesting happened. Barclays CEO Venkat had just delivered his version of the denial. We lend to top-tier managers, we use their loan portfolios as collateral, no material concerns, that whole speech, standard stuff. And then the reporter asked him, if all of that is true, wouldn't lower prices right now create a buying opportunity? Would Barclays step in and buy the dip? One word. Unlikely. That one word is worth more than every talking point that came before it. Think about what that means. You just told the world you have no concerns, no exposure worth worrying about, and you will not buy the dip. If you genuinely believed what you had just said, you would be buying. Because a panicked sell-off in a market where you have no concerns and strong collateral is free money. Unlikely is not the answer of a man who believes his own press release. At least he was honest about that part. Now I need to make something clear before we go further. A lot of people think this is a US problem, dollar-denominated, American shadow banks, American funds, American mess. That is completely wrong. The data from last fall already showed that European banks had moved into what was effectively a shadow bailout of shadow banks. And it was happening in euros, not dollars. European private credit grew into its own bubble on its own timeline, with its own cast of institutions. And those institutions have the same structural problems as their American counterparts. Same liquidity mismatches, same collateral questions, same dependence on credit conditions that are now deteriorating. And the ECB's own data backs all of this up. Look at the fourth quarter bank lending survey from last year. This came out before the March oil shock, so before any of the current drama added extra pressure. What it showed was this. Eurozone banks unexpectedly tightened corporate credit standards at the end of 2025. Not loosened, tightened, raising real doubts about investment and economic activity. Bloomberg was shocked by the results. The actual survey language was blunt. It called what the banks were doing a reflection of a high degree of risk aversion and a prudent approach to lending. Read that again. High degree of risk aversion. That is not the description of a credit market that is in a good place. That is the description of lenders who have looked at their books, looked at their borrowers, looked at the macroeconomic backdrop, and quietly decided to pull back before things get messier. And what were they most worried about in that survey? Corporate credit, which sits right at the heart of the private credit story. Now here is where the balance sheet behavior becomes impossible to explain away. If everything is fine, if the denials at the conference were genuine, then what do you make of this? In January, European banks purchased the second highest volume of government bonds in any single month on record. Not in recent memory, on record. Then in February they did it again, even bigger. By the end of February, those 2 months together had crossed 100 billion euros in government bond purchases. That threshold has only been crossed in a 2-month window 2 other times in the last 20 years. The first time was early 2012, the European banking crisis, the one that nearly broke the Eurozone. The second time was early last year, when global markets were shaking from trade war fears. And now, we have a third time. So, let's be direct about what we are looking at. The ECB keeps telling the public Europe is in a good place. And the banks those same ECB officials supervise are stockpiling safety assets at a rate that has historically only happened during genuine financial emergencies. The more the phrase good place comes out of Frankfurt, the faster these banks seem to be running toward liquidity and safety, as if they know the narrative being sold to the public is not quite the whole picture. It is not what they say, it is what they do. And what they are doing is not consistent with a banking system that believes its own conference talking points. Now, Apollo's Jim Zelter was in Melbourne last Thursday, telling a conference that negative media coverage pointing to systemic risk in private credit could not be further from the truth. BlackRock, Blackstone, Blue Owl, State Street, all running the same line. Nothing to worry about. Not systemic. Fine. Let's look at what is happening in the plumbing. Tarman described the transmission mechanism clearly. Private credit funds have locked up capital. Investors cannot easily get their money back. So when pressure hits and investors need liquidity, they do not sell out of private credit directly. They sell whatever they can sell. Public bonds, public equities. That is how private credit stress becomes public market stress. That is the chain. And that chain is already under pressure. And then there is JP Morgan. Look at what the largest bank in the United States just did. It moved to revalue the collateral it holds against its lending to private credit-linked funds. That is a collateral downgrade, and that is a massive signal if you understand the process. JP Morgan is distancing itself from private credit providers, pulling back, reducing its own exposure. That is not the behavior of an institution that has been reassured by what it is seeing. Because once you understand how collateral revaluation fits into the 3-stage crisis process, everything else clicks into place. And I want to be clear about those 3 stages because people always focus on the wrong thing. It is never really about the losses themselves. People want to know, how big are the write-downs? How many defaults? That is not the story. The story is the process, the sequence that turns credit stress into a liquidity crunch, and from there, into something that reaches far outside the original problem. That 3-stage model fits 2008 almost perfectly. From the earliest warning signs right through to the various meltdowns. Central bankers missed it every step of the way. Bankers at conferences kept saying everything was fine every step of the way. And the process kept moving forward anyway, because the process does not care what anyone says at a conference. Meanwhile, behind the scenes, the ECB has actually started paying attention, quietly. According to people familiar with the matter, the European Central Bank is planning a new round of checks on the banks it supervises, specifically focused on private credit exposure. It plans to formally ask banks for details of their dealings with direct lenders, the same kinds of institutions that the conference executives were busy telling the world they had almost no connection to. Previous exercises like this covered about a dozen banks. This new one is expected to go broader, and the Croatian central bank chief, who was about to become ECB vice president in June, did not mince words. He said regulators have already seen a worsening of the quality of private credit portfolios in a number of cases. Then he added, "If there is any propagation of this, we have to make sure the financial sector stays stable." Propagation. That is the word a central banker uses when he is genuinely worried about contagion. That is not the language of a man who has been reassured by what he is seeing. That is the language of someone running models and not liking the outputs. And you wonder why European banks are loading up on government bonds. On one hand, they got pulled deeper into the European private credit bubble last fall. On the other hand, they are building a safety buffer, liquidity reserves, ballast against the scenario Tarman is describing. Both things are true at the same time. They are exposed and they are hedging against their own exposure. Now the macro picture is making all of this worse, not better, worse. Germany's IFO Institute published its business expectation survey last week. The index dropped to 86 from a revised 90.2, the lowest level in more than a year. IFO's president was straight about it. Iran has put any hope of a German recovery on ice. Uncertainty among companies has risen noticeably. Spain was the first major European economy to report a CPI for March. It came in above 3%. That sounds bad. Actually, it was less bad than many feared. Why? Because the underlying economic weakness in Spain is already so significant that it capped how much the oil shock could push prices up. Pre-existing weakness acting as a ceiling on inflation. That is not a sign of health. That is the economy already broken enough that the usual price transmission channels are partially blocked. OECD has already begun downgrading European GDP forecasts. Put all of that together, weakening growth projections, business expectations at a 12-month low, corporate credit tightening that was already underway before March, an oil shock layered on top of all of it. And what does that combination historically produce? It forces central banks to cut rates, not raise them. Cut them significantly, which is the most important irony in this entire story. European central bankers right now are talking about hiking. They see the short-term CPI spike from oil, and they see a mandate to raise rates. Some of them have been almost gleeful about it, giving the financial media exactly what it has been hoping for since 2022, another chance to run the 1970s comparison. But oil shocks do not produce sustained inflation. They never have. Not in 1973, not in 1979, not in 1990, not in any of the 2000s instances either. Every single time the result was the same. Recession, demand destruction. Activity slowdown. The short-term price spike is real, and it is temporary. The economic damage underneath it is what lingers. Jean-Claude Trichet learned this the hard way. He was ECB president in 2008, raised rates in June of that year solely because oil had pushed consumer prices higher. Did it again twice in 2011. Same reason. Both times he was hiking directly into economic deterioration, ignoring the credit stress building under the surface. Both times it ended with the ECB doing emergency cuts months later as reality caught up with the rhetoric. The ECB is now being pulled toward doing exactly the same thing again. And here is the contrast that should embarrass European policymakers. On Thursday, Mexico's central bank, Banxico, restarted its rate-cutting cycle. Let me say that again, restarted its rate cuts. In the middle of the same global environment where European central bankers are scrambling to hike, Mexico looked at the exact same oil shock, the exact same global backdrop and said, "Our bigger concern is the downside risk to output and employment, not the upside risk to consumer prices." And here is what makes that call even more significant. Mexico was already seeing consumer prices accelerate modestly before the oil shock hit in March. They knew CPI was going to look ugly in the short term. They cut anyway. Because they understood what oil shocks actually do to real economies. Because they were not distracted by the inflation hysteria being fed by European central bankers. The future trajectory of European interest rates is almost certainly going to look more like Banxico than like what the ECB is signaling right now. So here is where we are. Pull it all together. Deutsche Bank broke ranks and told you the systemic risk is higher than people appreciate. The bank with the most private credit exposure in Europe is the one bank warning you to pay attention. Every other bank at that Morgan Stanley conference delivered a denial, but Barclays CEO said unlikely when asked if he would buy the dip, which tells you everything you actually need to know about whether those denials were genuine. European banks bought over 100 billion euros in government bonds in just 2 months. That has only happened 2 other times in 20 years. Both times were during genuine financial emergencies. The ECB's own bank lending survey showed a high degree of risk aversion in corporate credit before the oil shock even arrived. The ECB is now quietly running new examinations of private credit portfolios. A senior central banker about to become ECB vice president used the word propagation to describe what he is watching. JP Morgan revalued its private credit collateral. That is stage 2 of the process that does not care what anyone says at a conference. And the oil shock that is currently dominating the headlines, it is going to produce ugly CPI numbers in March and April. And then it is going to do what oil shocks always do: slow the economy, raise unemployment, suppress demand, make the credit problems that we're already building even harder to manage, and force the ECB into rate cuts it is currently pretending it will never make. Deutsche Bank's Tarman is right. If it were not for Iran, this would be all we are talking about. It should be all we are talking about, and now you know why. The gap between what Europe's bankers are saying and what Europe's banks are doing has never been wider. Historically, when that gap opens up this wide, it does not close because the statements were right all along. It closes because the balance sheets were telling the truth the whole time. Watch the balance sheets. Watch the collateral adjustments. Watch what these institutions do with their own money when they think nobody is paying attention. Because that is where the real story lives. And right now, that story is telling you something very different from what you are hearing at the conference podiums. As always, thanks for being here.